Welcome, everyone. I'm excited to bring us together for Reps and Warranties Insurance. As deal activity continues to rebound and we look forward to 2025 and more deal activity, I'm joined today by Stacy Hammer, Wayne Datz, and Drew Levin to talk about Reps and Warranties Insurance. Wayne is a managing principal at ASQ Underwriting, a boutique transactional risk managing general underwriter. He co-founded ASQ in 2018, following 20 years of diverse legal and insurance experience, including senior positions with global insurance carriers and as a corporate attorney at large international law firms. We are also joined by Drew Levin, who is a partner at Latham & Watkins in their LA office, handling insurance, recovery, and other matters. We're also joined by Stacy Hammer, a transactional vice president at Woodruff Sawyer, and she has had a long litigation career in New York City. And with that, I'll start and throw it over to you, Wayne. First, thanks all for joining. I should mention questions, please put them into the chat. Wayne, could you give us a little bit of information? Tell us about Reps and Warranties Insurance. What is it? What's it meant to do? Why do we want it?
Great, thanks, and thanks everyone for attending. So Rep and Warranty Insurance, pardon me, I'm going to go back to like really the basics. In any merger or acquisition scenario, there's going to be an acquisition agreement. And that acquisition agreement is going to determine the rights and obligations of the parties. And so Rep and Warranty Insurance, part of those agreements will have reps and warranties, simply put, from the company and sometimes also of the seller. And the reps, go from the sort of the obvious as, we're a Delaware corporation or wherever we're founded, we are authorized to do this deal. And then it gets into more complex kinds of reps around financial statements, around tax, and around compliance with laws. And then there could be a slew of others, including usually see, depending on the deal, environmental type reps, IT type reps, if there's government contracts, all of those things are encapsulated in the rep and warranty section. What used to be, I guess if you go back, several years, you would see more likely an escrow, which would mean that the seller would put a check that the seller would put aside roughly 10% of the enterprise value for a transaction into an escrow, that if there were a breach of the reps by the company or their sellers, the buyer could access that. And so that was usually the escrow lasted about 12 months and maybe 18 months, 24 months being the outside. And it was probably a more combative process if there was ever a time to access the escrow, because you would have a seller. Oftentimes, that seller and the management team of the company would continue with after they were acquired. And so you may have some disagreements that could become, between the parties that could become, detrimental to the future business as an ongoing operation. What the Rep and Warranty Insurance does is it really eliminates, or certainly decreases, the need for there to be any escrow. The policy takes the place of the escrow. And the policy also has longer duration. So it goes 3 years for general reps, which are sort of your standard operating type reps. And it goes 6 years for what we call fundamental reps, which are a little bit more, sort of like the standard reps that you would give as far as your organization and your cap table, and also importantly tax. And the reason why tax is included is that is 6 years statute of limitations. So it enables any buyer for any tax matters to come to the policy for 6 years to match these statute of limitations should anything arise. And so that's sort of like the basis of rep and warranty insurance, and why companies buy it. I think part of the rationale there is it's really helpful for buyers, particularly PE buyers, because they can take that escrow money, which is sort of trapped capital, buy a policy, and then either use that money to distribute most likely to their limited partners, or to reinvest if that fund is still ongoing and they want to purchase another company. So it helps them in that sense. And I also think it diffuses some of the conflict between buyer and seller, should there be a claim, and buyer and management team. And it also helps because our policy limits are 3 and 6 years. So those are like sort of a high level of what the rep and warranty and why it's beneficial. I would say that, probably the most important thing is what it doesn't cover, which is actual knowledge. So that's broadly defined in a policy. It's not a very easy bar, but I think buyers of insurance understand if there's a known tax matter or there's a known environmental matter or known litigation, that the rep and warranty policy would not pick that up. And I think that sort of is in line with what would happen in an ordinary course transaction that would have an escrow, because the buyers would and sellers would probably negotiate that the sellers would keep that issue. And that would retain liability for that. So we kind of track that. And, I would say other than that, it's a very broad policy. We cover all of the reps for the most part. Obviously, things that are learned by the buyer in diligence, we sort of sit on top of the buyer's diligence, where have all the buyer's diligence reports. So those are the kinds of things that you'll often see known matters that are subject to exclusions, but there are also standard exclusions, as I said, for actual knowledge. These policies don't cover asbestos. Sometimes you'll see if there's large pension plans, underfunding of those is just endemic. So the policies won't cover that. And occasionally, depending on how relevant it is, transfer pricing, those are generally not covered by the policy, as they're just sort of fundamental risks to the business that even escrows wouldn't pick up. But I'll pause there, I should say, and see if there are any questions or anything that Stacey or Drew want to add to that.
Great. Well, thanks, Wayne. That's a great overview of what reps and warranties insurance does and doesn't cover. Stacey, Woodruff Sawyer is a premier brokerage. What kind of clients do you see looking to purchase this type of insurance? We've heard what it is. Now, who wants it?
More and more over the years, we've seen that everybody seems to want it. We have a lot of PE firms who, these are obviously organizations that pool money to purchase businesses, and they generally are doing quite a few deals over the course of a year. And over time, we've seen that when people become familiar with the product, they often tend to use it on most, if not all, of their transactions going forward, if possible. We also have a lot of strategics, a lot of standalone companies who might be looking to purchase a complementary organization that might help their business, or maybe they're purchasing a competitor, looking to merge with a competitor. So you see a lot of those as well. And then the third pool that we see are not necessarily clients per se, but we have a lot of law firms who, once they and their clients have been using the products, their clients have had success with it, have had successful claims processes with it. They see what the benefits of the product are. They start recommending it to their clients. So law firms have been very big in the push to make this product more and more popular over the years, because the product itself in the US has existed for about 20 years. But over the past 10, it's really started exploding or so, especially in the last, I'd say 7 or so. It really just exploded in popularity, and more and more carriers are offering it in the US. It's existed overseas for a long time, and there are differences between the coverages, but in the US itself, it's become extremely popular, and we see people constantly calling to see if it would be a right fit for their transaction. And so we can procure policies to cover relatively small deals up to $1 billion or more with the capacity in the marketplace right now.
That's great. Thanks, Stacey. Drew, what do you think has driven so much interest in this type of coverage in the M&A deal market?
Sure. Thanks, LizabethAnn. I'll break it down into sort of two pieces. One, what started the interest, and two, why it's grown. I think what started, and Wayne and Stacy alluded to this, was largely PE funds who were winding up operations. They didn't want residual obligations or to keep their money in an escrow. So if a fund has made an investment, it's then divested, sold that investment, and wants to distribute its proceeds to its investors. Well, if there's a residual liability to its buyer, they might have to keep money in an escrow. They might have to claw back from their investors down the road. So they thought this insurance product might be useful. Insurers were willing now more than back then, and brokers encouraged them to offer this product. So it benefited the sellers, and at the same time, the buyer PE funds realized they were going to be in that position soon enough as well. So they came on board, even though it was relatively novel 10, 15 years ago. Why it's grown, and I think Stacy and Wayne touched on this as well. Two reasons. One, the benefits they've highlighted, and two, it strangely it works. The benefits are, and Wayne pointed this out, you get a longer survival period. It really does reduce deal friction between the parties. You are not negotiating an indemnity section. The reps tend to be more commoditized. You are able to move past that a bit quicker, and that facilitates getting a deal done. Likewise, you don't have the social issues. If you bought, say, from a founder who continues to run your business, you don't want to have to sue your own management team if there's a problem with the reps. So those are the benefits. I think why it works is sort of strange. It's an odd product because Stacy might go to Wayne and say, hey Wayne, you've never heard of this company before. Would you please insure the reps that are being made by this company, put $1 million of your own capital behind it? And at first glance, people are understandably skeptical, but the reason it works is I think the underlying dynamic just serves it being a responsible risk. So no buyer is buying a company because they want an insurance claim, right? They are buying a company because they think it has positive prospects going forward. Likewise, they're only buying 10% typically of the enterprise value. So they're underinsured if they really thought there was a problem at the company. Likewise, no seller really wants to, there's still exposure to the seller for fraud. So they want to make reps that are accurate. And all of the other deal participants, the lawyers, the tax and accounting advisors, they are duty bound to advise their buyer clients about any problems they see. So the insurer gets that information. And I think because of that dynamic and because we've all had so many reps together over time, I think there has developed a trust in the product. Likewise, I think buyers and sellers have come to generally trust it as well. That wasn't always the case.
Thanks, Drew. We've had a question from the audience. Stephen has asked, can a U.S. company use the product outside the United States? I'll throw that out to you, Drew, or Wayne, or State. You all three probably have answers to that. So whichever one of you wants to take that one.
I'll go first, I guess. So we are, we're an MGU, Managing General Underwriter, and our paper is only with travelers. So they back us 100%. We have a more limited international, I would say, appetite than others. So we are, we'll do deals that have international aspects that will, include a majority, well, I would say this, less than a majority of their operations overseas. And if it's more than a majority, then it would be a little bit of a different analysis, but we've still done those as well. But I know there are other cross-border deals that are done in the U.S. marketplace that have even, more foreign risk. I would say that it's not just the U.S. market. London is active, and the Hong Kong or China and Singapore. Those are all deals are getting done in those areas as well. So it's there are little differences in coverages and also requirements as far as retentions and the like. But you can, as a U.S. company doing a cross-border merger, you can certainly get coverage for your deals.
Great.
Yes,
Thanks,
I
Wayne.
would tack
Stacy,
on.
yes.
I would add that, you know, depending on the carrier, as Wayne said, you know, his company has certain guidelines, what they can provide to a client. Various carriers can and cannot, depending on their guidelines and their insurers. But it also will depend on what country's law the purchase agreement is subject to. So whether the buyer is foreign, whether the seller is foreign, it really is going to come down to what law the purchase agreement falls under and what the jurisdiction is there. Drew, if you have any further insights to add to that.
Yeah, no, I think this insurance is available, you know, in every jurisdiction just about that where people acquire companies. As Stacy mentioned, the domicile of the named insured plays a role in which insurers have the capability to insure in that region. There are differences in deal structure and related coverage structures depending upon the jurisdiction you're in. But we navigate those types of things all the time, and those policies are available. There are brokers and insurers involved who are looking to facilitate that process wherever your target is located.
That's great. Thanks. We have another question from the audience. I'm asking whether reps and warranties insurance can address employment agreements and unionized workers and such, and how that factors into the coverage on reps and warranties insurance. Any thoughts on that?
Yeah, I mean, that's a great question. And, you know, I didn't mention it in the beginning, but employee benefits and employee matters are also reps that we see all the time. And so we are covering those as part of the rep package. You know, employment agreements, if there are those active with management, you know, that'll be part of our analysis. You know, I would say that for the most part, we always bring outside counsel in. They'll have experts in labor and benefits. Drew will bring his experts in from Latham, and they will also speak to what, you know, their full diligence they've done on it. Unions can be included in that, obviously. You know, there are pluses and minuses from a risk perspective of unions, but it's definitely part of the coverage and something that in every deal you're looking at that. I don't know if that's full answer, but.
That's great. Stacy, Drew, anything you want to add to that before we move into the actual process of getting reps and warranties insurance?
I would just add that during the underwriting process, which we'll be touching on in a moment, all of the parties will be looking closely at the diligence that has been undertaken and provided, and that will include issues such as, you know, whether there's union activity, whether there are any employee agreements, and the underwriter will look into the responses and how thorough and robust the diligence has been to see if it's something that they're comfortable with providing coverage for.
Thanks, Wayne. Thanks, Stacy. And thanks to Christopher for the question from the audience. Each of you has touched a little bit on the process of underwriting for reps and warranties, thrown out words like diligence and other aspects of deals. So can you take us through the actual reps and warranty underwriting process from the beginning of a deal, when you get that for, hey, we might do a deal, we should maybe think about insurance, all the way through closing of the transaction and binding the insurance?
Yeah, I can take that one. As an insurance broker, we are the party who steps in first. We would be getting a client calling or shooting an email saying, hey, we're undertaking this transaction. We wanted to explore the possibility of reps and warranty insurance. We would talk to our client, give them all the ins and outs of it. And in order to go out to the markets to obtain potential quotes, we ask for a copy of the purchase agreement. Ideally, it's gone through at least one round of negotiations, although the carriers are used to seeing an auction draft or, a very early draft of the agreement. We provide the carriers a copy of the purchase agreement, a copy of the target company's financials, as well as a deal book or a SIM that they might have a confidential information memorandum. Based on those 3 bits of information, and we have the carrier sign an NDA if the client requests, the carriers will provide us with their quotes, also known as a non-binding indication letter. We will obtain those from the markets. Right now, there's almost 30 markets in the US that offers reps and warranty insurance, so it's a very competitive market. Once those quotes are obtained, we provide them with an analysis that we at the brokerage determine, what we think would be the best fit, what has the broadest range of potential coverage for the deal, what has the most competitive pricing, and we provide it to the client. Once we determine which carrier to move forward with, the selected carrier will sign non-reliance letters for all of the diligence that will be provided from outside advisors, whether that's a memo from Latham and Watkins, with the full legal diligence. We have the financial and tax insurance diligence, as well as insurance diligence that would be provided. So if a firm like Ernst & Young is on board with their memorandums, we'll get an NRL signed for that. At the end of the day, when all of the diligence is provided to the underwriter, we'll set up an underwriting call, which all of the outside advisors, along with corporate counsel for the buyer and the buyer's deal team, as well as the brokerage, we will all be on the phone for a fascinating 2-hour call to talk about all of these different areas. The specialists will get on, so Drew's colleagues in the IP department or the tax department might step in and oversee those areas. Then as the underwriter, Wayne would be asking questions, would provide an agenda prior to the call so that there's an overview of what questions will be asked. And based on those questions and the diligence provided, we will learn what potential exclusions there might be on the policy. And it's my goal as the broker to help negotiate the policy language along with Drew and the underwriter. We would come to negotiate a policy that is satisfactory to all parties by the time the deal signs. So from soup to nuts, this can all take as little as a week from the time you select a carrier to the time we sign a deal. So it's a really quick process on our end. A PE firm or a client might be looking into a company for months before we get called in, but by the time we get called in, it's toward the end of the process.
So Stacy, you mentioned that there are 30 markets interested in writing reps and warranties insurance. What does that mean?
There are various insurance carriers in the US who provide reps and warranty coverage. So there might be insurance companies that people have heard of, the Liberties and the AIGs of the world who, they are known for being brick and mortar companies that offer a lot of different products. Then there are companies like ASQ where Wayne and his colleagues, that as he mentioned before, he's a managing general underwriter, which means he has the pen for companies that back ASQ. So they're writing on another carrier's paper, but they are the ones making all the decisions and negotiating everything. These policies are very specific and manuscripted, meaning that every single one is different. It's not a form that just gets given to each potential client. They are tailored for the particular deal, for the particular industry and the client, and there's a lot of nuance and negotiation that goes into it.
I think I'll It might make sense to highlight one point. It's a question I've had in the past because I think some buyers are worried that this is sort of a whole separate, entirely sort of, equally involved process as their underlying deal, and that it's a complicating factor as opposed to a facilitating factor. In my experience, that's not how it works. We have, done deals with Wayne for years and with other carriers, and it's a fairly well understood process. So it's our goal, in the term sheet stage with the carrier to, clarify expectations so we all know how we expect this to go, what the diligence is going to look like. And then in the underwriting phase, um, there are fairly standard market expectations of what sort of information is going to be provided, what the policy is going to look like. Certainly, if we were doing a policy with ASQ, we would start with our last negotiated form with them, which means we are, not starting from scratch and recreating the wheel. We're focused on very specific things. Um, and uh, certainly welcome Wayne's thoughts, but I think the bid ask on this is generally fairly well understood, right? We work through problems, but insurers and insureds rarely, I can count on one hand the times it's really fallen apart because of a dispute over policy terms after, thousands of policies. It tends to work really in tandem with the underlying deal and not, at odds with the underlying deal.
Yeah, I completely agree with Drew. And one of the interesting points is, obviously as an underwriter, you are a bit at a informational deficit. So there are times when I may be putting in an exclusion and that I think is required for under my fiduciary duties to travelers, and I'll get a call from Drew or an email, with Stacy, and we'll go through it, like why I'm misunderstanding, or they'll provide additional information that maybe, the person on the phone had represented something that was just slightly different than the actual facts. So there is a lot of collaboration among the parties. And so I agree that I don't think it's at all a pain point for the buyer or sellers. I think it actually probably makes the process go a little bit smoother.
That's great. Thanks. We've actually had another question from the audience, from Ian, about software and technology companies and how a buyer or a seller who might not have been as forthcoming about technology gaps in diligence, whether or not that's something that can be addressed via reps and warranty insurance if there are technology gaps or other issues with the business. Does that fit into reps and warranties insurance?
Yeah. I think, one of the things that we focus on, because I had mentioned earlier that IP and IT are both parts of every call that we do, every underwriting call throughout the marketplace, regardless of even the business, right? We've seen enough now in the cyber marketplace that construction companies that are B2B may have cyber exposure and may have experienced an event of some type, be it phishing or what else. So we do look at that. Obviously, depending on the business, it gets more attention. So if it's a true IP or technology business, we will expect to see more in the way of diligence, which probably fits in with what the buyer's doing anyway, because obviously if you're buying a business like that, then you have a much greater concern about, do they own the IP? Is their technology up to snuff? That we are, we're confident that when we combine systems, or reasonably confident when we combine systems, that we're not going to have an issue with, somebody has been on their system and now has gained access to our system for nefarious purposes. But everything is a balance, right? So when you have a true tech company, obviously we're going to put less time into condition of assets, which would be a bigger thing in a manufacturing business, or environmental exposure, which is also more likely to be an issue if you have a B2B chemical manufacturer, right? So, but IT and IP is absolutely part of every deal. The level of focus on it really is dependent upon the company, but we see those deals as being beneficial. I mean, we feel like we have the expertise to underwrite to them. And, we see the marketplace diligence being pretty strong in those areas. And we also understand sort of like what we think to be some of the gaps that we can try to address through underwriting or through the diligence process that don't cause us as many concerns. And then on the claim side, I would say we're seeing, we'll talk about this later, obviously, but we're seeing more claims in the, sufficiency of assets, and that's not something you generally get with, true tech companies, true SaaS companies. So there are benefits there.
And I'll make a quick related point because I've had this question before, in various contexts, but consistent with Wayne's answer, the policy is not a substitute for diligence. The policy relies upon diligence. Now, as there is a balance, as Wayne says, you're going to spend more time where more of the value and more of the risk at the target exists. But the insurance does not supplant the underlying diligence that you would do essentially independent of insurance. It relies upon it.
I would also add, as a broker who who has a company that places lots of policies, when we do a deal and we get the non-binding indication letter from a carrier like Wayne, he might say we require there to be a standalone insurance policy for certain areas, such as a cyber policy. So it's not. One isn't to look at the reps and warranty policy as a replacement for having proper cyber coverage. The reps and warranty policy will sit excess of that. It won't not cover a cyber incident, but it will expect there to be actual cyber coverage to respond first to any issue.
That's great. We've had another question following up. You've now mentioned, and I think we'll get to it, but it's a great question. What kind of loss experience have insurers had, and how are claims paid, and what does a seller do to determine the amount of coverage it needs if it's buying reps and warranties insurance?
If I could start off and, going back to the initial, when we talk about what the policy is meant to do and replace the escrow, you often see sellers purchasing roughly 10% of the enterprise value. So if the deal's $200 million, they're going to buy a $20 million policy. I think as we've seen pricing come down significantly since the highs of the 2021 year, you're seeing additional coverage being purchased because it fits within their intended spend, as well as they may want some additional coverages just because I guess they're sleeping well at night. So as far as claims, I just think at this point, and we're going to start to put this in the MBIL at some stage, but people that have been around for a significant period of time, the claims are out there, right? I think roughly we have had, we've paid over or around 150 million in claims for about 50 different deals, something along those lines, where they had experiences, and they've ranged from from the mundane, like, inventory, the inventory count was off, or they had the inventory that we thought we could use for other clients has actually had a logo put on it, so it's unusable. And those are sort of more financial statement claims, and those are more typical, to some more novel, tariffs, seat licenses claims, and others. So, but I think at this point, there's the policies and the procedures in this whole industry wouldn't exist if claims weren't being paid, because what would be the sense, right? So I think there are very, marketplaces that are out there that have been here for a long time, are active in their claims payment. Lots of resources are put towards that, both at the carrier side and the MGU, MGA side. And so it's the proof is in the pudding. Like we were talking a lot here about the underwriting process, and all that's great, and all that gets people comfortable. but ultimately, if you have a claim and it's not getting paid, what's the sense of the insurance? So that's a critical aspect that we focus an awful lot of time on with travelers, and really that's something that we try to highlight, that experience. I can't say that every claim experience is going to be easy, because it's some of these claims are difficult, and the facts and the requirements to get the information can be cumbersome, but there's always the effort to come to middle ground, to be reasonable, to collaborate. And that's really how I think the industry has grown from what was sort of a niche play years ago, 6 carriers in the marketplace, let's say 2013, 14, to now 30 carriers and billions of dollars worth of limits of liability placed by the marketplace.
So Stacy, welcome your thoughts, but I'll just jump in with one sort of structural point that I'm not sure we covered. Either buyer or seller can pay for the policy. Certainly the insurers don't care where the check comes from, but the policies are typically placed with the buyer as the insured. And the reason is that generally serves everybody's interest. The sellers don't want a liability policy covering them. They want to be able to walk away free. And the upside to the buyer is that they are covered even if a breach involves seller fraud. That wouldn't be the case if the seller was actually the insured, because then it would be the insured's own fraud. So that's how the policies are typically structured. I used to do about one seller side policy a year. My guess is that the insurers did not do well with even that number of policies, because I see greater resistance on the few times we've tried to go out and place one. But certainly echo Wayne's comments on claims. We tell every client at the start that the insurer is coming in cold from a policy they wrote a year, 2 years, maybe longer. They haven't thought of it. So it's only fair to give them a chance to get aboard, to understand the claim, to be transparent, because if you treat it as adversarial from the start, it's going to take longer and be tougher. And it's really helpful, candidly, when people at the insurer like Wayne remain closely involved with the claim, as opposed to just turning it over to outside counsel, because that's further afield from the parties who made the deal in the first instance, I'll say.
And I will jump in. As Drew just mentioned, it's usually the buyer who is the insured. We didn't necessarily talk about this before when we were talking about the policies themselves, but these policies have a self-insured retention, which is basically, you can think of it as another way of calling a deductible, and the policy sits above that. So if there is a $20 million policy, as Wayne mentioned before, on a $200 million company, there might be $1 million of retention that needs to be paid by the client, by the buyer, who is the insured on the policy, before the 20 million in coverage would kick in. So that being said, we do see a lot of claims that either resolve or settle within the retention amount, but once it's above the retention amount, I work with all of the carriers on their claim side, as well as placing policies. And I can tell you that the carriers are very invested in paying out claims. They want you to have a good experience. They want to be seen as a carrier who pays out claims, because if there's any difficulty, if they are not paying out claims for bad faith reasons, if they are being irrational in their questions or dragging things out, then it's going to have a bad effect on their business side. People aren't going to want to work with them. People aren't going to recommend working with them. A client might say, I had a bad claim experience with this particular carrier, so I have a new deal. I don't want to place a business with them. A law firm might be representing their client in attempting to recoup money from the policy, and the law firm might say, I didn't enjoy my experience with this carrier on the claim side, so I don't want to place any business with them. So it all is interrelated, and the business people at the carriers know that. So you have somebody like Wayne, who actually Wayne is very involved in the claim side as well. It doesn't always happen that the underwriters are, but they are very invested in getting their underwriters involved on the claim side too, because they're the most knowledgeable people to deal with talking about the claim at hand.
Great, thanks. That's those are helpful answers to the question. I have one follow-up. Ballpark, how much does a policy, say a $20 million policy cost? What can a client expect to spend, a buyer expect to spend to obtain such a policy that we've been talking about?
I will give you my stock answer. They don't cost enough. In the height of the market, like after COVID, obviously there was a lot of backlog. People were keeping their powder dry. People were figuring out, and this is in 2020 really, how do we do deals in this new environment? And I think the marketplace got comfortable. So by the end of 20 and then really into 21, there was a real the velocity of deals and the number of deals getting done was incredible. And so all of the markets, were up. Deals were getting, we're doing just an enormous amount of business, enormous amount of reliance upon, counsel. I'm sure they were incredibly busy, outside forces of, third-party providers, everyone, private equity, sellers, buyers alike in corporate. So at the height of the marketplace then, and it's really supply and demand, there was so much demand, you were probably talking about, somewhere in the 4% rate online. So if you're thinking of a $10 million policy, it would probably cost you about $450,000, let's just say. Now you can buy that same policy for $250,000. And again, it's really, or about, just giving it, like we're probably in the mid-twos rate online right now, or maybe a little higher. I think we're seeing some rate hardening. So it's going up to probably into the later twos, but it's something that there's a back and forth. It's really a supply and demand issue. And so there are more markets out here in the marketplace that are willing to underwrite and insure deals, and there are fewer deals. I think we're seeing that pick up, but there have been, I think, ultimately probably need to be higher than the mid-twos to sustain the losses over the long run of the industry. So we'll see how that plays out, but it's not always directly correlative that, what you're getting in your loss ratio is what you're able to, write policies that are rate online sufficient to cover those. So I think there'll be some reckoning in the short and medium term from the markets and the reinsurers and the insurers to see where we wind up here.
Yeah, that's consistent. We're seeing as well.
I think rates are perfect the way they, no.
Great, thanks. Well, Stacy, earlier you mentioned that this policy has been available for about 20 years in the United States. And it sounds from our discussion like it's more of a bespoke policy. How has the market evolved over the last 20 years? How has it changed?
The policies have become so much more buyer-friendly, insured-friendly than when all three of us began in this industry. As Wayne mentioned, years ago, I started doing this 10 years ago. And when I began, there were 7 carriers in the US who offered this product. And now, as we mentioned, there's about 30. And back then, the retentions were 2% of, now we're seeing even less than 1%. We're seeing as low as 0.5% of the purchase price being the retention on the policy, and they even drop down after the first audit cycle, after the first 12 months or so. So you've seen limits come down. You've seen many of the language, much of the language within the policy has become much more buyer friendly. And that's thanks to firms like Latham, where, you know, they'll have a lot of clients who use the policy, and we're negotiating the wording. And when they're successful in getting certain wording, certain advantages for their clients, they'll ask for it for the next policy and the next policy. And it just basically then becomes a market standard, because if you're getting these advantages from ASQ, but AIG isn't giving them, then AIG is going to realize, hey, we're not getting the business. We need to get in line, and we need to give the same types of advantages in our policies. So there's a lot of things to go toward the law firms in this industry for making it a lot more buyer friendly. And it's our role as the broker to know what is market out there and what just is really beyond the realm of norm when you're asking for a particular modification to a policy. I mean, Drew's been negotiating these policies pretty much, you know, as long as I've been doing this, and you've seen a lot of changes, and you're responsible for some of them. You know, what can you speak to that?
Yeah, I mean, I certainly agree it has moved, you know, in favor of the policyholder over time. But I also think it, you know, Wayne can disagree. I think a lot of it is generally to the benefit of the entire industry, and I'll give a couple of examples. I think foot faults in policies are bad. If an insured loses coverage for some failure to comply with some term, but it doesn't really impact the insurer, it might be a short-term gain for an insurer to get out of a claim, but I think it's long-term bad for the industry because people don't want to use a product that operates unfairly. So I think, you know, a lot of our focus over time has been to get foot fault type language out of there. If we see things happen strangely in a claim scenario that don't seem fair, we might address that in an update. And I think the other sort of focus is just on avoiding ambiguity, right? I think everybody benefits when there's clarity about what everybody's obligations are, what's excluded, what's not. So I'll give an easy example. It's not common in R&W policies. We see it in some others that we address. Some carriers will put in a comment, a provision that says that the insured will act as if uninsured at all times. We tend to push against that because, candidly, I'm not quite sure what that means. But you know, we would then have a sort of more specific discussion with Wayne or whomever and say, what is it that you think they need to do to be a good citizen under this policy and properly cooperate with you in the event of a claim? So, I mean, I think, you know, clarity and fairness is sort of the North Star of this. And I think that's a real reason why it's continued to grow. But Wayne, you can tell me I'm way off base.
No, I agree with you. I think, you know, in other policies and other lines of business in the management liability space, which this falls under, you really have differences, you know, terms and conditions. These are admitted policies for the most part. And so because of that, if any litigation, like you know, some of the D&O policies at this point, many of the terms have been litigated and they've been determined by court, so people understand their meaning, right? And here, that doesn't happen. We're not going through formal litigation. I mean, we have, of course, there have been and there have been arbitrations, but not, you know, you're not filing your rates and forms online. I mean, excuse me, with insurance regulatory departments. And some of the vetting that Drew talks about is exactly what that almost is replacing it, right? We want clarity. We don't want to be in a position where it's a foot fault that results in, you know, either way, really, but that results in frustration, right? Because I mean, there could be a point where it could work for and against us, but it doesn't really help overall the markets, you know, going forward and the usefulness of it if we're relying on you know, foot faults to get out of claims. And I don't think that's ever really held water, and Drew and others have helped, you know, hey, listen, this is a fair, I think you said it great. You know, that fairness and clarity is the key. And so where we can make it better, You know, and then also because it's not admitted, there are times when you get a form and then maybe someone weighs in, a lawyer, not Drew, but others, that may make it less clear and may make it because they prefer this wording for whatever reason. And so, you know, those are like picadillos that you can live with them, and sometimes then you have an amendment to an amendment to an amendment, or a revision to a revision to a revision, and you kind of lose the forest for the trees. So I think though we're in a good position. I think the market, the big law firms and active participants have really set a standard for policies that it's not huge vacillations anymore.
Yeah, I would agree with that. It's pretty much known what is market. You know, for those of us who did this all the time, it's, you know, if there is an amendment that isn't really going to fly. So by and large, the carriers all pretty much adhere to what we all consider to be market standards. There might be certain asks here and there that might go for additional premiums. You know, we might say, hey, can you extend the policy period to 7 years, for example, or can you consider some of these general reps to be fundamental reps and provide them a longer policy period of coverage. But by and large, the terms within are pretty standard at this point.
And about what percentage of deals have reps and warranties insurance? What's the percentage of the M&A deals done in a year that might have reps and warranties insurance?
Great. I think at one point the brokers had put out that for private equity deals, we were talking about upwards of 67, like 2/3 or higher, have rep and warranty coverage. And corporates were less than that, but have since, I think, caught up. So I would say the majority of deals now have rep and warranty insurance.
Those are the figures I've seen.
Yeah, and we've seen a lot of auctions where the seller is requesting and requiring that the potential purchasers obtain quotes and come with for their purchase package. They want to see it in there. So a lot of times it's a requirement.
That's helpful context. Thanks. Wayne, when you're looking at deals, how do you analyze them? What are your top priorities?
Yeah, it's a great question. You really want to know the target and the marketplace. That's our primary starting point, right? We will get the reports from as Drew had noted. Most of the time, we're dealing with the buy side. Buyers are buying the policy, so we have access to their diligence reports. We have access to the virtual data room that the seller has put together with all of the relevant documentation, and we go through that as well. But we really want to understand, at a high level, starting off, what the business does, the industry in which it's operating, regulatory concerns, and just, a bunch of other factors that would go in. But you would almost like starting very broadly and then narrowing it down. And that's what we sort of try to, we rely on individually, then also, our company knowledge. And so then we really dig in. To me, it's helpful to understand, the business and what it does at a high level, and then you start to really dig into the diligence. And ultimately, one thing that we pay very close attention to is we're not really insuring a company. We're insuring words on a paper, right? We're insuring the reps and warranties. So you also want to have the same focus on the scope and breadth of the warranties, so that your questions, or at least your considerations, and if something needs to be disclosed or excluded, you're focusing on the actual rep, so that you're aligning with that, because that's ultimately where the breach will come into play, not from our business, we didn't realize that. I mean, it could fit into a rep, but it's not necessarily just a business risk.
Great. Thanks, Wayne. Stacy, what's the role of a broker in the process?
My role, you mentioned at the beginning that I come from a litigation background. I started my career as a litigator, and so I think of it often in the mindset of mediation, where it's my role to advocate for my client, but I also have the institutional knowledge of the industry and what is market, and I also have relationships with all of the underwriters. So it's my role to kind of shepherd my client through the process. I'm there to handhold and to explain things 20 times if they need it, and it's not a problem because I want you to understand and I want you to feel as though you are understanding every aspect of the experience and that you're comfortable with every aspect of the experience. I'm there to negotiate with the underwriters. So I would call up Wayne or shoot him an email and say, hey, we're thinking about, would this tweak be acceptable to a policy when you have a law firm come and say, we want to ask about making these changes. I'm able to say, you know what? The carriers aren't going to go for this because we've asked before and we understand their rationale and it's not a market request. And so I'm there to manage expectations. I'm there to shepherd toward a happy, result, and to basically put all of my experience at your disposal.
Great, thanks. And Drew, how do you approach negotiating a policy?
I think, consistent with our discussion before, I all of these policies, I've done scores of policies with Wayne over the years. With Wayne and the other carriers, we are going to start with the general terms and conditions, essentially resolved from the last policy, unless there's been movement in the marketplace or we've seen some, change with other carriers that we want to bring to Wayne's attention. From there, we will largely be focused on deal specific items, mostly the exclusions, if there are any. And with that, that's going to be a conversation typically, because again, we want clarity about what is supposed to be excluded and what is not. And it's far easier to do that with a discussion on the A side than when you have a claim down the road. There's a lot of money at stake, and people are trying to figure out, what imprecise words were intended to do.
Thanks, Drew. Well, we've only got a couple minutes left, and so I'll throw out, what do we think 2025 holds for reps and warranties, insurance, and M&A activity? What trends are you seeing? What do you expect to see in 2025? And let's go around the horn. Drew, we'll start with you.
I think there is feels like there is an increase in activity as of late, and I think that will potentially impact rates and retentions. I know Wayne is hoping for that. But listen, the rule over time has been expansion. If you go back, 10 years ago, it was a narrower set of insurers with narrower appetites for specific industries, for specific deal structures. What's just happened year after year as more expertise and more trust has come into the market is that appetite, the availability, the utility has broadened. So healthcare deals, gaming deals, which used to be relatively difficult to insure, now there's a lot more appetite. Secondary sales, minority investments, take privates. These deals can now be insured, whereas 5-10 years ago they couldn't be, and I think that's just going to continue.
Great, thanks, Wayne. Any thoughts on your end?
Dare I say I agree with Drew again, but I do think he's right, and I think the other issue, one thing that is pretty incredible about being in this marketplace in the last several years is, we went from global pandemic to a war in Europe, world unrest in other places, including the Middle East. And, the economy in the United States is so strong that it really continues, and deals continue to happen. And I think probably the biggest thing is the availability of money. And so, as interest rates come down and there's more leverage in the marketplace, I think we'll see, hopefully a greater number of deals and the velocity of deals in 25 picking up. I don't know if they get to 21 levels, but certainly above what we've seen the last couple of years.
Great, thanks. And Stacy, we'll give you the last word.
Yeah, I would agree with both of my panelists, but also I do think that we are going to see a rising of premium and retention amounts just simply because the policies need to sustain themselves, as Wayne mentioned earlier on. Pricing has gotten very low because there's been a dearth of deals for a while, and also there's just such an influx of new markets out there. They're trying to get a foothold, that it's been a race to the bottom for quite a while, and I think that has stabilized and is making its way back up, which is not to say that the policies are becoming expensive, because they're not, especially when you compare it to doing a deal without having rep and warranty and just using the standard 10% escrow amount. There are just so many benefits to the product, and people who have used it and law firms who have used it have seen that it's just becoming, it just keeps on becoming more and more popular.
Great, thanks. Stacy, Wayne, Drew, thank you so much for joining us. And this has been a really informative discussion. I appreciate you taking the time to join us at an Cornell session. So thank you. And with that, we'll wrap up and say goodbye to our audience. Thank you also for joining us.